Welcome, Christina.
Yeah, come on up here, Christina.
All right, good evening. Wonderful to see so many faces. Thank you. This is great. Okay, so how many people are here because you just love economics? It's your favorite topic in the whole wide world. Okay, there's like 5 of us. Okay, that's about right. So in 2000, so I started investing 40 years ago. I was about the size of that little baby running around. Okay, obviously I wasn't. But I did start investing, and I went through the Great Recession. Remember 2000, 2001, 2002, 2003? Anybody? Any of us? Right? Okay, so are these the same hands who now love economics? Did you learn what I learned? Which is my brilliance, my intelligence, my enthusiasm, I'm such a fantastic blah, 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 meant zero when the whole economic was falling apart. My intelligence wasn't the thing that was going to save me, and it wasn't the thing that made me so brilliant. I owned a house, was flipping in 2 different states, and I owned a house for a year, and it gained 25% in value in that year without me touching a piece of it. I sold it a year later, making no changes, and thought I was so smart. But I wasn't. The truth is, the market was going up, and all ships rise with the tide. And all ships fell with the tide. So my big learning curve was 2009, 11, right? As I'm selling everything, literally everything. Because my why behind being in real estate was to be a mom. I wanted to be able to pick up my daughter from school. Now, maybe that seems like a really simple thing, but I grew up with a mom who was a single mom who ran her own company out of our house. And being picked up from school wasn't something that happened in our house. So sometimes my mom was late. Sometimes I took the bus 2 hours to school and back. And my feeling, what I made that mean inside of myself was that I wasn't important. Now, is that the truth of what was happening, that I wasn't important? No. The moms, why? All the moms in the room, we all know that, right? What was my mom doing? Every one of you are right. So I wanted to secure my financial future first so I could pick up my daughter on time. So my daughter was born in September of 2006. Actually, I got married in September 2006. My daughter was born in 2009. What was happening in 2009? The real estate world was falling the frick apart. So I literally sold everything. I owned 350 doors in 7 different states, was flipping in 2 different states. And I sold everything, whether it was performing or not. Whether I took a loss on it or not, I sold everything. And I turned what I had left over into doing hard money lending, because hard money lending let me do what? Be with my daughter. So I salvaged what I could to get my dream. My dream was to be a mom. So how many of us have a dream or a vision, something we really want to do, or somebody we really want to be free to be? Okay, I'd be surprised if I don't see every hand in this room raise up, right? Because even if you're a successful investor, even if you have a portfolio, even if you've got 300 doors of your own, or 2,000 doors of your own, if you're still sitting in this room, that means you're still getting, excuse my language, you're still getting shit done. You're still growing yourself. You're still expanding your portfolio. You're still expanding yourself as a human being. You're still challenging yourself to move forward. You're still progressing in your life, and you're still engaged. And that's why you would come here for a completely boring topic like economics. So I appreciate you guys being here. But as much as anything, I appreciate your dedication. This is who I want to be. This is how I want to be. So I'm going to get myself here tonight. I respect that. So, let's see. So, economy, what we're in right now, let me ask this question real quick. How many people think that 2026 is going to be a great year for single family? Okay. Can you raise them high so I can see? Thank you. Okay, how many people think 2026 is going to be a horrible year for single family? Okay, a couple. Okay, cool. Anybody who invests in multifamilies? A couple of you guys. How many people think that 2026 is going to be a good year for multifamily? For purchasing. That is a very important statement he just said, isn't it? All right, so I'm going to go through a series of slides. It's going to be completely boring. I apologize for that piece. I'll try not to have it be completely boring, but it will be kind of boring. And then at the end, I'm going to go through single family and multifamily, and then we can have a conversation around that. How does that sound? Good? All right. So I'm going to do macro first, then housing, then I'm going to do upcoming economic rentals for single and multifamily, and then some investor takeaways, some bottom line. And yeah, we're just going to have to deal with it. Not all my slides transferred over well, but that's all right. And I'm not going to read everything on the screen. Deal? You guys can read it yourself? If you want these slides later, you're welcome to them. Cool. All right. Learn economics. Understand your world. Why would I be so attached to that? Didn't I explain that already? Right? That's not my brilliance. All ships rise and fall on the tide. My brilliance is understanding the tide. That's how I got passionate about economics. All right. Oh, that's supposed to be later. Okay, growth is still positive, but slower than 2024 as far as GDP. So, gross domestic product. We have the largest gross domestic product of the world. Do you know that? The only thing that's larger is the EU as a whole. That's part of why we're the financial leaders of the world, is we just make and produce a lot of shit. Mostly services, not so much products anymore. Our GDP is part of what we ride on. Normally, we like to see about 2%. Are we seeing 2% this last year? Just about. The number at the end, 2%. CBRE thinks it's going to be 2%. But slowly, economics usually supports the case for lower rates over time. If our GDP goes down too much, then the Fed will decrease interest rates in order to stimulate the economy. But it's not negative. Negative means recession. See, 4 quarters ago, we had a negative GDP. It actually went down a little bit. Okay, inflation is much better than in the 2022 stock period, but it's not settled cleanly at the 2% Fed rate. That's what the Fed wants to see, about 2% inflation. And if we go below 2% inflation, then they're worried we're going to stall out. They'll lower interest rates. If we go above, then they worry about inflation, especially if we head into 6%, 7%. Then they're worried about hyperinflation. Anybody invest during the Reagan eras? So I started investing in 1986. So anybody remember those really high interest rates? Hi, Andy. Me and Andy. I actually have my gray beard. Right? So Fed goal is 2%. Headline inflation right now is 2.8%. Core, PC, which is what they generally watch, is 3%. I'm just laying out a bunch of data. Okay? So we managed to go back. Thank goodness. You could see how those steeper curves. Inflation was 7%, 8%, and then what did the Fed start doing in March, 2.5 years ago? They've jacked up the discount rate, which jacked up the inflation, which jacked up the lending rate. Labor market is softer but not broken. Now, here's the thing. You can see unemployment is going back up again, but it's still 4.4%. But generally, the unemployment rate, there we go. Historically, it's 4 to 6%. Average is 5.7% unemployment. Are we above or below average? Huh? Below. That's meaningful to the Fed, because even though we see increased unemployment, we're seeing the change in purchasing power. Is the Fed going to be responsive to this yet? Maybe not. Okay, but the Fed did cut rates because we were seeing slowing. We saw GDP slow down, we saw unemployment go up, so we've seen changes and the Fed cut rates. How many people think that the Fed is going to cut more rates this year? Cut the rate again this year. How many people leave one more time? 2 more times? 3 more times? Okay. All right. This is the dot plot. Anybody familiar with this dot plot from the Fed? Few people? This is people's opinion. This set of dots is people's opinions about where they think they want to target having the lending rate be. Now we see this is all pretty much in agreement, right? Over here. But then in 2026, do you see they're drifting down? In 2027, they're drifting even further down. So the majority of the opinion is here, then further, then further, then further. But notice still 3%, not 2%. So what does this mean? It means that the Federal Reserve, which is the people that focus on whether they're going to move the discount rate or not, isn't themselves declaring that they want to see a 2%. They seem to be declaring that they want to see 3%. Okay, moving on. We're just collecting data. Good. All right. So let's talk about housing, because I've been focusing a lot on the interest rate, right? The Fed, basically. I've been laying it down. And what I want to say as sort of a conclusion is, okay, unemployment, the Fed rate has been pushed down, but maybe the Fed might be close to being done if they're targeting 3%. And they're at 3.5 right now. Maybe unemployment is going up, but we're not really too far below the average. Maybe inflation hasn't quite hit 2%, but it's less than it was before. Maybe growth is still solid and GDP's gone down, but we haven't stalled out. So that's the groundwork I'm laying. And I'll let you guys ask questions about this later, but just kind of hold that data for now. Now let's talk a little bit about housing itself. Mortgage rates. Why do I care about mortgage rates? Who wants to tell me why I care about mortgage rates? I'm trying to make this interesting, audience participation. Why do I care about mortgage rates? Yes. How much can people afford based on payments based on interest rates? Mortgage rates, people say, is a direct result, directly affects the price of housing. How many people believe mortgage rates directly affect the price of housing? How many people disagree? How many people think there's a lag? I'm the only one who thinks there's a lag? Okay, I got 2 who thinks there's... Andy, you don't think there's a lag? That's correct. May I suggest? Oh, please. That's correct. Uh-huh. Right. What's with that? I mean, that makes no sense. All right, I'll piddle out a little bit of a piece of data, and then we'll keep building my argument, if that's okay. So generally, rates are going up because inflation is going up. And inflation is going up, what happens to commodities when inflation is going up? Okay, I hear some head nods, but let's speak it out. Commodities go up. Is real estate a commodity? It is. But eventually, there's a breaking point. Because when interest rates go up, even real estate, which is a commodity that requires interest to pay for it, borrowed money to pay for it, it will start to break. When cost of goods gets too high, then an industry will start to break. So I'm going to suggest there's a lag in the system. Is that okay, my opinion? Anybody want to argue with me? I'll argue with anybody. Come on, I'll take you on. I'll take you on. Go ahead. Depends on the market. Absolutely. Uh-huh. You've seen part of my presentation. You sneaked at it, didn't you? You snuck a peek. Anybody else want to argue with me? Come on, I'll take it on. Sure, he was saying that my comment makes sense in a certain environment, and that environment is California real estate, where we don't have enough physical assets on the market to experience the same volatility that other markets would experience, right, if interest rates were going up and the market was more independent floating and not having other factors affect it. Does that answer it? Is that repeating it okay? Cool. All right. So mortgage rates, currently 6.11%. Better affordability helps transaction activity but does not ease the structural supply shortage. Okay, do we have a shortage in the US of housing? How many people were already aware of this before I said that? Yeah, we do. We have a shortage of housing in the US, right? Demand is responding to modest affordability improvement, but the market is still undersupplied relative to normal turnover. So here we have inventory versus sales. And when we have a lack of inventory, we have a lack of sales. When we have a lack of sales, we have a lack of activity. When there's a lack of activity, does a asset reset its price very quickly? Not quickly. Thus the lag effect being even more true in California than it is in other states, or in some of the other major cities. Because it's true in Chicago, it's true in New York, it's true in California, it's true in St. Petersburg, right? Okay. So, supply gap, 4 million. Used to be 6. Hey, we're making progress. This is great. But across the U.S., we have a supply gap of about 4 million units in or in residential, everything residential. By the way, I've been investing in residential for 40 years. I do residential. I apologize. Everything I reference is residential. I'm not industrial. I don't do commercial. So I apologize for that. So housing starts. So starts are 1.487 million for January 2026. But we need 1.5 million new units a year to keep up with the population growth. So are we getting ahead or behind? Or right on? But right on. And this goes up and down, right? COVID, development went down, supply went down. Rental conditions are stabilizing but not overheated. More vacancy and more concessions usually mean listing is becoming more competitive, especially in a heavy supply submarket. Good news for renters and operators with strong retention systems, but tougher for weakly managed assets. Okay, I own single-family, multifamily in Indianapolis and Tulsa, and more multifamily in Tulsa than I do in Indianapolis. My vacancy rate is now 8 to 10% in Tulsa. Now, do we have that vacancy rate in California and Los Angeles? No, we're 3 to 5. So I'm actually struggling filling units in comparison to what I'm used to, because even though GDP hasn't gone down, it's weaker. Unemployment has gone up even though it's below normal, right? Even though we're seeing that the interest rates are going to maybe hold the interest rates where they are, there is a contraction in tenant base. I can tell you that personally. So if we have a lack of housing, how am I experiencing contraction in tenant base? Can anybody guess at that? Yes. Huh? Tenant base, as in I'm getting less tenants. Yeah, it's okay. I'm just getting less tenants. Any thoughts on why am I getting less tenants? Sure, go for it. Okay. The effective ICE was less than 1% of the entire population. True. As a nation, as a national number. That's correct. And actually it might be 0.1%, but I have that later.